In this video, we look a little closer at the different types of responsibility centers. There are three. There are cost centers, profit centers, and investment centers. Now, in a cost center, we are holding the manager of that cost center responsible only for the expenses incurred. That manager has no influence over the revenues, so he would be evaluated based on how well he or she controlled the costs. In a profit center, the manager here has influence over sales, so he's going to be evaluated based on the profit, that is, the revenue minus the expenses of that particular profit center. And then we can go one step further. We can look at the profit in relation to the investment that was made in that division or responsibility center, and we can relate the profit and come up with what's called a return on investment. This is a typical report for a manager of a cost center. The cost center is the finishing department. This is a responsibility report, and it assumes that the department manager can control all manufacturing overhead costs, except he has no influence over depreciation or property taxes. And so therefore, we line up the budget. He had a budget of indirect materials. He was going to spend $13,500. He spent $14,000. Therefore, it's $500 unfavorable. Indirect labor was under his control. He was budgeted $18,000. He spent $17,000, so he controlled that pretty good. Utilities, pretty close. So there are the comparison of actual to budget based on those costs that are controllable. This is the report for a profit center. This is a division, marine division. The manager is responsible for sales and controlling costs. $600,000 of the indirect costs are not controllable by the manager, therefore they're not part of this report. To begin with, he had budgeted sales of $1.2 million and he came in with $1,150,000. So he has $50,000 unfavorable. As far as the costs go, the costs are broken into the variable costs and the fixed costs, the controllable fixed costs. The variable cost of goods sold, $500, he came in at $490. While that is favorable, selling in a min is favorable, but he actually sold less. So of course you would expect the variable costs to be a bit favorable. We're not talking about a flexible budget here. Anyway, we come up with what's called the controllable margin. This is a new term. Controllable margin is the contribution margin minus those controllable fixed costs. In this case, they said the controllable fixed costs would be the cost of goods sold and selling in min. So his controllable margin then would be the $140,000 contribution margin minus the controllable costs, fixed costs. And he noticed that the fixed cost did not change, so he has no variances on that. So you see, he's evaluated by profit, but it's not strictly profit in its normal sense. It's called controllable margin. We don't include those fixed costs for which the manager has no control. Now, if the manager is responsible for profit, as well as how much money he has invested in his particular responsibility center, then we call that an investment center. And all we do is we relate the controllable margin to the amount of money invested in the division. And so we get what's called an ROI, return on investment. So as we had before, that manager had a contribution margin of $540 was budgeted. He came in with $504, so he has an unfavorable contribution margin. And when you add in the controllable costs, he comes up with $264,000 controllable margin. And that means that he was unfavorable by $36,000. When we relate that to the investment he has in here, his goal was to come up with a 15% investment, but because he had a controllable margin of $264 instead of $300, he comes in with a ROI of 13.2. So we compare the ROI of 13.2 to the budgeted ROI of 15. And in that way, we evaluate the manager of this investment center. So there we're talking about evaluating performance of managers based on the kind of responsibility center they have. A cost center, we only look at measuring the manager's performance as to how well he or she controlled costs. In a profit center, it's controlling costs, but also how well they promoted sales. And in the investment center, we add the idea of investment.